But what actually happened is that after the firm recover from the BlackBerry inventory, they also have some mismanagement inside the firm that lead to the stock issuance. You know what? That I have to add more money to the firm as well.
Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risks, but to win big, you've got to reduce it. My name is Andrew Stotts from A Stotts Investment Research, and I'm here with featured guest, Mr. Roongkiat Ratanabanchuen. Dr. Roongkiat, are you ready to rock?
Yes.
All right, let's go. So, Dr. Roongkiat is currently working as a full-time lecturer at Chulalongkorn Business School. He graduated with a Bachelor's in Engineering, in Automotive Engineering from Chulalongkorn University also, and a Master's of Science in Quantitative Finance from Cass Business School, and a PhD in the topic of pension fund management from the London School of Economics and Political Science. Sounds pretty smart. Fund management and bank management. He was awarded the 2017 CFA Institute Best Paper Award in Microstructure, also a research scholarship in microfinance from the National Research Council of Thailand, and recently a research scholarship in the area of risk management of saving cooperatives from the Thailand Research Fund. Roongkiat, take a moment. Tell us a little bit about yourself.
Okay, so actually I am now currently working as a full-time lecturer at Chulalongkorn Business School. And I'm also an associate director of the BBA International Program here as well. So if one of you are interested to apply for the BBA program, then you can contact me as well. Yes.
Fantastic. I was just talking to someone recently who was talking to me about the quality of education in business in Thailand and how much it's improved compared to when people like myself came here many years ago. So that's great. So now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstances leading up to it and then tell us your story.
Okay. So my worst investment ever happened maybe 7 years ago. And actually, it is because of my mistake in analyzing the future prospect of the firm. And at that time, the firm that I invested in has got some problems about selling the products. Okay, and this kind of firm is just a wholesaler. Okay, they sell BlackBerry smartphone, BlackBerry smartphone. And in that year, the sale dropped a lot. Okay, and I think that the stock price has dropped so far. Okay, so I decided to get in after the stock price dropped. Okay, but because of my mistakes in analyzing of the period that the business will turn around, then I have to stay with the firm for more than 4 years. You know what? At first, I thought that the business can recover from the loss of inventory maybe by 2 or 3 quarters. But what actually happened is that after the firm recover from the BlackBerry inventory, they also have some mismanagement inside the firm that lead to the stock issuance. You know what? That I have to add more money to the firm as well.
Let me clarify that. So what you're saying is that the company was in enough trouble that they had to come up and raise more capital, and you were faced with the choice of saying
more capital. But the reason for raising this capital is not about BlackBerry sale, but it is about mismanagement of the company after the problem of BlackBerry,
And the problem that you were faced with at the time, just so that listeners understand, is that you had already invested money into this business and you were probably frustrated at the performance. And then the company said, we need more money. And if you don't put in more money, you're going to actually, the value of what you have is going to fall even further. And therefore, your choice is either at that time to get out or put more money in.
That's right. That's right. Because at that time, if I decide not to put more money, I will have to sell at the price that I am going to lose around 50% of what I put in.
Basically, there's hope that if you pay the money into the company, and this is a dilemma that many people face when a company is raising money, your hope when you're putting money in is that the company will use that money to make good investments and good returns so that the share will be worth a lot more in the future.
Yes, that's right. But at that time, just that I don't have no choice, and I just have to put more money and wait for maybe 1 or 2 years that the business will recover from the second problem that they create. So it took me around 4 years before I can get out from that business. But when I got out at the price that I get around 10 or 20% of profit. But the problem is that I lose the period of 5 years that I have to wait for everything to become normal.
So if we look at that and we say you made a return of 20% over the time, that would mean, let's say you made roughly, 4% or so per year, if we think of it simply, and you had a huge headache along the way, I guess.
Yes, that's right.
And so what you're saying is the thing that made this the worst investment for you was the time lost. You could have invested in something else, gotten a higher return, and not had as much of a headache. Is that what you're saying?
Yes, that's right. Yes. And actually another problem that I also face with this investment is that I tend to put more stake in the company along the way. You know what? At the beginning, I may just put just a tiny stake, but after the stock price drop, and then I feel that, okay, I think the company can recover from the problem very soon. So I put more stake. And then maybe at the middle of my experience, my whole portfolio consists of this firm for more than 50%. And then therefore, when I have that kind of big stake, when the company asks for more capital, it's quite a hard time for me to decide. Yes. So my second lesson is that I put more concentration on this company. Yeah.
And let me ask you about that. So when we talk about the lessons learned, and clearly you don't want to be so heavily weighted in any one investment like that. But the reality is you didn't go into it planning that. You went into it saying maybe 10 or 20% of your portfolio would be in it. And what happened over time was that you got pulled deeper into it. So maybe we could just try to summarize, what are the lessons that you learned from this?
Okay. So actually, my first lesson is that when you invest in a troubled company, you need a lot more experience because it is quite difficult to forecast when the company can turn around. And my second lesson is that when you invest, you need to have some discipline that you need to limit your concentration of risk in a certain company, okay? And don't put too much money on one stock or two stocks, because if something happens that you don't expect to happen, then you may have to decide, and then you may end up at the situation when you don't know what to do next. Because you don't allow some flexibility on your portfolio.
That's great points. And maybe what I'll do now is summarize my takeaways from your story. One of the things, it goes back to a paper that I actually wrote and published when I was doing my PhD. And that was trying to balance risk and return for the average investor. And in that paper, I basically came to the conclusion that 10 is the number of stocks that the average individual investor should hold in Asia. Meaning, if you hold less than 10, you're not getting the benefit of diversification. So you may be hoping that you get a higher return by owning 5, right? If you own the right 5, you may get a really high return. But the reality is that 10 is enough to eliminate about 80% of the risk related to individual stocks. Now, the other problem, the other constraint that we have as an individual investor is it's hard to find and monitor stocks. And therefore, owning more than 10 stocks would be almost impossible for someone unless it was a full-time job. So that brings us to the point is that if that was the case, if ideally an individual could hold 10 stocks, my next recommendation is they should hold them in equal weighting. And I think that brings us to the point that you make, which is at what point does a value of a stock go above or below that 10% that you have to say, okay, I promise myself I will take action. Well, above it, I've done a lot of testing and have found that above, letting it run is not a bad thing. But on the downside, that's where you get the opportunity to say, if this goes down, let's just say I bought it at 100 and it goes down to 80, I'm out. And I think that brings us to another point that I think is really valuable about your story, is that something that people don't think about is that each investment that you have could require more money. That's not everybody thinks about that ahead of time. Of course, if you have a startup company, everybody plans that it's not going to take that much money and all that, but eventually it's going to take more money. So you must be ready to double, let's say, the amount that you've invested in that startup and have that money available, or else you or the startup could be in trouble. The second thing is something related to a public company or a listed company is the concept of a rights issue. If a company decides to raise capital and they do a rights issue where you get a right to buy the shares to keep your proportion of ownership the same, the fact is that could double the amount that you have to pay into the company. If you don't have that money available to do it, the value of your existing shares are going to fall. So I think that from an investing perspective, one of the lessons I take away is that to remember when you're investing something that you must be prepared that at least some of your investments will actually consume more money than you thought, and you'll have to put more in. So be prepared for that. Those are my lessons. Would you have anything you would add to that? Did I miss anything?
No, not at all. Because actually what I learned is that at that time, my investment style is that I invest less than 5 stocks, as you say. But after my experience, then I add more stock to my portfolio. And then at this time, I have around maybe 10 or 15 stocks in my portfolio. Yeah.
Yep. And
just to reduce the individual risk of each firm. And then now I change my way of investment into something that I focus more on the factor investing. I may come up with some kind of factor that I think it may create some additional return for me, but then I try to remove all the individual risks, and then I will just only have that kind of factor risk in my portfolio. Yeah.
Got it. Okay, so based on what you learned from this story and what you continue to learn and teach, what one action would you recommend our listeners take to avoid suffering the same fate?
I think it's a difficult question because sometimes if you avoid, then you may end up selling at the bottom. You know what? So what I suggest is that you will not end up in this situation if you have a diversified portfolio, and then it will be easier for you to maybe just let it go and then begin it again.
I think that's great advice. And the point is if you had a diversified portfolio of, let's say, 10 stocks, and one of them, you needed to contribute to one of them, you could always sell one of the other ones to raise the cash necessary. So I think that's great advice.
Yes.
All right. Well, listeners, there you have it. Another story of loss to keep you winning. To find more stories like this, previous episodes, and resources to help you reduce your risk, visit myworstinvestmentever.com. Now, as we wrap up, Dr. Roongkiat, thank you again for coming on the show. I know it's painful talking about our losers, but our listeners are learning to win as a result. Do you have any parting words for our audience?
So good luck with your investment. Yeah, and don't end up with my situation. Okay.
Great lesson. Learn to diversify and put that into action. Well, that's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, I'll see you on the upside.